Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and multifamily investment expert, Brad Sumrok. Now, Brad is a nationally known educator and mentor in the multifamily investment space. He got his feet wet way back in 2002 and has since owned over 8,000 apartment units throughout 11 U.S. markets. In addition to his own investment endeavors, Brad also teaches and has taught tens of thousands the proven time-tested essential of how to profitably invest in apartment buildings and find their fast path to retirement and passive income through his Rat Race to Retirement training program. And so with that, guys, I'm excited to welcome my guest for today's show, Brad Sumrok. Brad, how you doing, my friend?
Hey, I'm good, Kevin. I'm excited to be here today.
Yeah, excited to have you here. Again, as we were chatting about here before we started rolling, we probably have some overlap in the space. We've never met in person. We're not really meeting in person now. We kind of are. I think Zoom now, I think that's almost equal to being in person. Not as fun, right? Not as formal. But anyway, we're here now. Had the opportunity to chat a little bit. We know that we both spent a lot of time here in the Tampa Bay market. Found out that we've got some even connections, not my family, but your family. I do a lot of cycling with your brother-in-law. And so small world, as we find ourselves here in the real estate investment space, there's lots of overlap, surely. But in any event, Brad, excited to have you here. Excited to pull back the curtains a little bit, learn about your business and what it is you do. But why don't we roll back a little bit and start from the beginning? For those that aren't familiar with you and your story, take a few minutes and just tell us a little bit more about yourself and ultimately how you found your way into the real estate investment world.
Yeah, if you would have asked me 20 years ago or 30 years ago if I ever thought that I would be a real estate investor, that I would be financially independent from a job, that I would be teaching and mentoring other people, I would have been like, no way. Because my going all the way back, like, what is a mentor, right? Like, my parents were my first set of mentors, like so many out there. And you either learn what to do or what not to do from your parents. And my parents taught me to study hard, get good grades, go to college. And neither of my parents finished college. So all that we knew, Kevin, was formal education, right? And formal education is what we need to do. And if you want to better yourself, you need to have a second degree or a third degree or some sort of formal training or formal certifications. So, my parents never went to college. They encouraged me to study hard and get good grades. And I did. And I went to college and I became an engineer. And the reason I became an engineer, it wasn't because, my parents didn't say, do what you love and the money will follow, or I just want you to be happy. It was like, do something that's going to make you the most amount of money. Yeah. And my dad finished 3 years of engineering school, and his boss made double or triple than what he made. And I remember, our family would pack our station wagon and we would go on beach vacations in the car. And my dad's boss would fly his family to Hawaii. And so I just remember hearing that over and over. It's like, look, if you get your degree, you could travel to Hawaii with your family and fly on a jet. And I never grew up flying on an airplane, right? So that's why I became an engineer. And then I wanted to move up. And so I went back and got an MBA because that was what I thought the ticket was to going from an engineering career to a business career, right? Was to get an MBA. But as you probably know, Kevin, an MBA, they just teach you, how to be middle management in white collar corporate America. And they didn't even teach me how to do my own financial statements, but they did teach me how to read other companies' financial statements. But here's the funny thing. It wasn't until I bought a piece of real estate that I actually had to understand my own personal balance sheet, my own income and expenses, my own assets and liabilities. Isn't that interesting?
Yeah, it's funny. There's still a lack of practical, applicable information that's taught in school today. So, but it sounds like we have a very similar upbringing, Brad. Let me ask you, where'd you grow up? It sounds like, again, neither one of my parents went to school. Just said, hey, get as good as grades you can get, and when you get a job, just find a good job. And stick with it, whether you like it or not. Just stick with it. Have that steady paycheck, because you don't know where that next job, if it's even out there, if it's available, right? So once you get one, be grateful and just suck it up. That's kind of what I was taught.
Yeah, well, I grew up in Pittsburgh,
okay.
and so my dad fortunately, he wasn't a blue collar worker, and he didn't lose his job like when in the 80s, when so many of my friends' parents lost their job when all the layoffs were happening in the steel industry. You know, that's what Pittsburgh is famous for. And my dad had a white collar job. And so he always had a job. In fact, he worked two jobs just so that we could have a little extra edge, you know, and we could take vacations, even though they were in the car. You know, we were able to take vacations, and we always had, looking back, I guess we were barely middle class, but at the time, you know, it was a pretty good childhood, but it was all about the money. It was like, don't go to college so you could be happy. It was go to college so you could make a lot of money.
Yep. No, that's great. And a little fun fact for you, I'm from Pennsylvania as well, from Harrisburg, so the other side of the state. And Pennsylvania is the only state that is referenced by its initials. When you say you're from Pennsylvania, you typically say I'm from PA, and you don't even realize that you're saying it, correct?
Correct. Right.
So
like who else says that?
There's no other state that says that. It doesn't exist.
That's true. I never thought of that.
Yeah. Anyway, moving on here. So let's talk about that very first deal, right? The deal that set the foundation for where you're at today. Again, you know, full-time in multifamily real estate, retired from the corporate rat race many years back. And so let's talk about that first foundational deal. What was it? You know, what really drove you to multifamily, you know, and then, you know, the deal, the location, the challenges, what you did, what you learned, all the above.
Yeah. You know, it's been 20 years. My first deal was in '02, you know, and here we are 20 years later, but gosh, the time flies. And so that's the one thing that people really need to understand is like 20 years, 10 years from now might seem like a long time away, but it's not. And so I can remember it like it was yesterday. And here's the deal. I would see all these advertisements to go to real estate seminars. And I'm like, I'm not going to a seminar. Like, what am I going to learn? I have 2 degrees. I'm smart, you know, like I got everything figured out. And I'm in my late 20s and early 30s. And then boom, I got fired. And then I got another job. And then boom, I got laid off because we got bought. And I started realizing that having a job wasn't as secure as I thought. And then I picked up a book that so many of you read, and I'm sure you read, Rich Dad, Poor Dad. And that book really put me on a different trajectory, Kevin. In that book where Kiyosaki talks about the difference between specialized education, which you get in seminars, versus formal education, which you get in universities, really opened up my eyes. And so it gave me the courage to actually go to one of these real estate seminars. And it's funny now because I do them, right? But back then I was the most skeptical. I was the most skeptical person. And I went to a seminar where they taught, you know, single family rentals, and then they taught multifamily rentals. And so I didn't study like 30 or 40 different ways in real estate to make money. I really studied 2. And I picked multifamily because it just made more sense. I had worked in corporate America for 14 years. I had, you know, over 100,000 available to invest. And so at the time, you know, the guy that did the seminars, he became my mentor. And he said, Brad, buy as many units as you can under one roof. And so I went out and bought a 32-unit building. And that was my first ever investment property. I bought it with my own money. I remember it like it was yesterday. I put 20% down, got an 80% conventional loan. It was like less than $1 million, like $970K. But I'm just telling you, this property put like clockwork, $4,000, $5,000 a month into my pocket every month, like clockwork. And it was incredible. And I still had a job, you know, so I was doing my job 8 hours a day. And then at evenings and weekends at lunchtime, I was learning real estate. So that's the first thing I always tell people is you don't quit your job. When you get started, you're going to have to do a little bit more than other people were willing to do so that you can have a life that most people don't have.
Yeah, no, I think that's an important consideration that most people don't take into account. I mean, you worked extra hard, maybe probably two to three times harder than a lot of your other colleagues that you were working with at the engineering firm at that point in time. But now look where you're at today, right? That work that was put in the front end, that concentrated work effort pays off, 10, 20x, maybe even more. And so, no, that's I appreciate that. And I appreciate you sharing the insights on that very first deal. And so I'd love to let's take some of the lessons that you pulled away from that very first deal. You're probably a ton of mistakes that were made. Your business model is probably slightly different today than what it was back then. Maybe go into some detail. Did you manage that one yourself? I mean, were you literally in the evening times, were you swinging hammers and fixing plumbing and, unclogging toilets, or did you outsource the property management? Just some of the additional intimate details of that particular first deal.
Yeah, it's so funny because there's some myth. By the way, if you look at my hands,
those are clean hands.
Yeah, I don't use tools. I don't do plumbing. I'm not a maintenance guy. The only tool I know how to use, Kevin, is a wine bottle opener. And so that's like the only my mind, of course, but the physical tool, it's like, unless it's a wine bottle opener. So look, I was definitely afraid of the thought of having to, do maintenance and stuff like that. And so, even with 32 units, which now I consider to be a small property, you have better economies of scale with 30 units than you do with 3 units. So with 30 units, I was able to afford to hire a part-time maintenance person, and he would come to my property about 20 hours a week. But I do remember, like, I had to go through 2 or 3 people until I found a good one. And in the meantime, during that transition, I remember going to Home Depot and looking for stuff, and I didn't know what I was doing. And I'm like looking for green board, and I don't know what green board is. And so, I mean, look, you don't want to have to do this. Like, unless you're a contractor, the biggest lesson learned is that bigger is easier. Okay. Bigger is actually easier. And I didn't learn that until my 3rd deal, because I did 32 and then 30. And the second deal was 30 units, and it was around the block from the first one. So it was like playing Monopoly. And what I found is that it was easier to run 62 doors than 30, because now I have enough cash flow and enough economies of scale to hire a staff. And so I had a full-time manager, a full-time maintenance person. But on 32, I'm finding myself having to kind of like piecemeal it together. And like, so what I did myself is I'm doing all the books, and I was able to teach myself QuickBooks. But my 3rd deal was 250 units that I bought with other people's money, because I was out of my own money. And now I have a professional management company with a full-time manager, a full-time leasing agent, a full-time maintenance person that's HVAC certified, a full-time housekeeper. Like, it was so much easier. It was so much easier, and the debt's better. The lenders want to loan on bigger deals. The management companies want to run the bigger deals. So lesson number 1, and I mean this from the bottom of my heart today, and it's what I teach my students, is that you could really skip that whole step of having to do it yourself. You could skip that first step and go into 60 units or more in a syndication model.
Yeah, no, fantastic. And let's talk about the world where we're at today, and let's keep politics out for the time being. However, I would love your perspective on just we're recording this. What is the date today, Brad? The date is March 8th, right? And so just an hour ago, literally before we started recording, Biden just announced that we're basically cutting off ties to Russian oil and natural gas imports, at least at this present time. And so obviously some craziness happening between Russia and Ukraine, but let's not chat about that right now. I don't want to get too deep there, but let's talk about the business model today and how that's changed from those first couple of deals. I know that bigger is better, right? You're doing bigger, larger scale deals. But more specifically, as it relates to really these last 2 years, right? With the pandemic, everyone kind of pulled back for a period of time. March happened. We didn't know if we were going to get our rent checks in April. We weren't sure if they're going to come in May. At some point in time, we felt there was going to be some fallout. The fallout never occurred. In fact, if anything, it literally put an octane boost behind that of your space, the mobile home park space, and a few other asset classes, and ultimately compressed cap rates and everyone's scrambling. Everyone's scrambling to put their money into hard physical assets, with again multifamily and mobile home parks being at the forefront of where investors want to be putting their capital. And so again, cap rates have been compressed, a little bit more challenging to find opportunities out there today. And so what does the landscape look like at present time? Are there still opportunities to be uncovered if you overturn enough rocks, or where are we at today?
Yeah, and let me just go back 2 years and comment on that, and then let's bring it up to where we're at today. This is so important, and it's important that people know and I'll say the truth, but I'll say my truth, but it's from somebody that's been doing this not for 2 years or even 5 years, but for 20 years. And I've been through the last downturn in 2008 and survived, and not only survived, but thrived, because the deal is there's always a winning strategy. There's always a way to pivot. And so like I've been buying apartments, whether it's an up market or a down market, but I'm not using the same strategies and I don't have exactly the same expectations. But if you're willing to pivot, for example, on your underwriting and on your investor expectations and regarding returns and on your debt strategy and the length of your debt and all these variables come into play. So, 2 years ago, we were just starting to shut down, like March of 2020. And you're right, there was so much uncertainty. And you're right, for a couple months, pretty much, my industry, multifamily, and probably everything else was on pause because people didn't know if people were going to pay the rent. In our industry, there were talks of rent strikes. The CDC made evictions, they had a moratorium on evictions. So people were able to live at your property and not have to pay rent. But the distinction that people didn't pick up on was they weren't forgiven permanently of not paying rent. It was still postponed. So if you didn't pay rent, it still accumulated. Okay. And then the government started sending out all these checks. And in landlord and business friendly states, like where you're probably invest and where I invest, like, Texas and Florida and the Southeast and the Southwest and some parts of the Rockies, these are more landlord and business friendly. Tenants prioritize paying their rent. So this is a fact. Okay. And I was just at an event last week with Tony Robbins and 6 billionaires, but I have friends that own properties in like New York or San Francisco, and they had 30 or 40% of their residents didn't pay rent. But in the markets that I'm in, the average was about 2%. And so what we saw, Kevin, is that we became very bold about 3 months into the pandemic. So by June of 2020, we were buying everything that we could. We literally put our foot on the gas while others put their foot on the brakes. And that decision, by the way, some people may say it was a gamble, but look, one of the keys to success is you got to listen and follow somebody at 1 or 2 or 3 levels above you. And no matter how good you are, or how many units you have, or how long you've been doing this, you can always find people that are ahead of you in that domain. Right? Like I have multifamily friends and advisors and mentors, some official, some unofficial, that have 20, 30, 40,000 doors. And so I was watching what they were doing and where they were buying, and I just followed in their footsteps. And so we put our foot on the gas. And I could just say from the last 2 years, it was the best of times in my 20 years. Okay, so that's kind of getting us up to where we're at right now. Literally the best of times.
Well, real quick, before we get up to right now, I want to back up. So what were some of those contrarian, at least now might maybe not consider contrarian, but back then, again, speaking to like May and June, what were some of those contrarian insights that you garnered from some of your advisors and mentors that you follow suit with?
Well, so we were tracking our rents every week, and we're seeing rents come in, right? And so we're hearing in the media, no one's paying the rent and there's rent strikes, but at our properties and our markets, rent's coming in, and they continue to come in. Okay. And then lenders even tightened up. Lenders in multifamily required what they call COVID reserves. So you have to put up extra money in escrow. And so that was more money down. And so again, there were a lot of people that hesitated, but here's what we saw. We saw that the supply, like even before the pandemic, we were bullish on multifamily because there's more demand for multifamily housing than there is supply. And then what happened, Kevin, is a lot of the construction stopped. And even though people weren't going to work, they were still getting paid.
Yeah.
And they prioritized their rent. And then ultimately in some of these markets that we're in, and ultimately, nationally, the whole CDC eviction moratorium was shot down by the Supreme Court. But like in Florida and Texas and some other areas, these were already being challenged.
Yeah.
Right. So we were looking at all of that without being political. We were just looking at what is happening. And if you look at the data now, looking back, the American consumer has more wealth now than they did before the pandemic. A lot of people, they were making more money during the pandemic than they were when they were working. And that was one of the challenges because people didn't want to go back to work, but they were paying their rent. They weren't just hoarding the money. So like 98% on average across not just my properties, but the hundreds and the thousands of my students and my mentors. So we're talking collectively hundreds of thousands of doors that we have a pulse on in 10, 12, 15 different markets. Everybody's paying the rent. Now there's less units coming on because all the construction and development are being slowed down even to this day where the supply chain shortages are happening. So we just saw and then as people started coming back to work, now there's even more demand for less housing units available. And Kevin, this is what caused the unprecedented rent increases that have happened and that are still happening in multifamily. And this is happening across the board in class A, B, or C. The vacancies are at an all-time low. The rent growths are at an all-time high. They're continuing to grow. And so that brings us, that's some of the viewpoints. And if you want to ask me more questions about that, please do. But the other question you asked me, the window is still now, and I believe that 100%, and I put my money where my mouth is. So like last year, me and my wife, if you don't mind me saying this, we put $8 million of our own money into multifamily, into acquisitions last year. And we're going to do something similar this year because, 2022 is the last year where all the bonus depreciation that was passed in late 17 this is the last full year, and then it starts to phase out. So it's the best tax benefit ever. The rent growth is still going up. The occupancy is at an all-time high. Interest rates are low right now, but they're projected to start gradually going up. So like, I want to connect with you next year, Kevin, or hopefully sooner. But like I am telling you, next year, people that don't take action and wait for the crash, they're going to regret it because the opportunity cost is going to cost them dearly. Yeah. And you need to be in assets that's going up in value faster than our currency is being destroyed.
Yeah, no, I agree with you there. And I'd love to get your take on the rent growth. Obviously, record rent growth in 2020, but more specific 2021. I believe that you've got some investments in Florida and Texas. I'm not sure what other states, but any of the key markets in Texas, any of the key markets in Florida saw 20% plus rent growth in 2021. How is one underwriting opportunities nowadays? Just understanding that can't go on forever, right? And so, what do the 3, 4, 5 year projections look like as far as rent growth is concerned? What's a conservative model?
Yeah, well, let me give you an example first, and then let me answer that. So here was the deal I bought at the end of 2021, end of 2020, and the rents are up 21%. And so if you just do the math, and this is a key learning point, by the way. So let's say the rents were $1,000 a month, and now they're at $1,210, which is about where they're at. It's a 154 unit deal. So the way you calculate the increase in value in multifamily, it's the increase in value divided by a market cap rate, right? It's the increase in income divided by the cap rate equal value. So $210 a month higher rent times 154 units times 12 months. And the market cap right now for this asset is about a 4. So you take 210 times 154 times 12 divided by 0.04. The property is up almost $10 million in value. So we paid $13 million literally a year ago. It's worth 23 today. Mine $4 million down payment. Now I got $14 million of equity. This is how we're building wealth. Okay, I guess I think you might have misunderstood the question. So the question would be, as you run out your model, right? Like you're gonna run 5-year projections when you do an acquisition, and each year you're going to have some type of
assumed rent increase in place. And one would say that it's probably being a little overzealous. If over every year for 5 years, you say it's going to increase 21%. And so on new acquisitions that you're making, what does that underwriting model look like? I mean, what are you guys putting in place as far as projected rent growth?
Well,
it's kind of wonky now based on like the last 2 years, right? Because like that can't run on forever. At least one would say that it can't run on forever.
Yeah. So the last 3 deals that I bought, I just re-underwrote them. Like I looked at, today is day 0, and I did a new 5-year projection. And this is how I'm teaching my students to underwrite deals in any new acquisition. So obviously we're not using double-digit rent growth in any underwriting. Mm-hmm. Okay. So we're not doing that. But what we are doing is we're getting hold of industry data. So, there's CoStar, there's Yardi, there's a whole variety of sources, of multifamily data that could be very specific down to the 1 mile circle around your property. And so we're looking at what's actually happening in that market at that property with those comparable properties. And so, for example, like in North Dallas, where I have a property, our underwriting is showing like a 6% rent growth this year, and then 5 next year, and then trailing down more to historical numbers. And a historical number is around 3 in DFW. And so what we're doing is, for these early years, like this year and next year, the rent growth is higher than average. Because right now it's still much higher than 6% in Dallas, by the way. Mm-hmm. But we're using like a 6% number, and that's just organic. So there's still value add increases too, where if you come in and uplift the property, you can get increases in rents too. So your underwriting right now has to take into account 2 things: organic rent growth, which we're gathering that from industry data, and we're seeing higher organic rent growth in like years 1 through 2, and then it tapers down to a historical number. Because look, the further you go out, you really don't know what's going to happen. Like, 12 months ago, we didn't know things were going to go up 30% in rent, right? So I could tell you this: 12 months ago, we were underwriting rent growth of 3%. And now we're underwriting, like, for the first year or 2 at 5 or 6%, and then kind of going back to 3. So does that answer your question?
Yeah, no, absolutely does. Absolutely. Yeah. And I think another component of that, as far as challenges associated with underwriting deals in today's climate, would be what the debt markets are going to do, right? And so looking at a value add type deal where you're going to put a bridge piece on and go bridge the perm, or maybe you're going to exit at the end, but either way, no one knows what that ultimate terminal cap rate is on the exit, or if you're going to put some perm debt in place, 2-3 years down the road, what does that look like, given the Fed's kind of guidance that they've given us as to, there's going to be a multitude of rate increases here over the remainder of the year. And then what does that look like in the future? And so how are you handling that, or how are you, guiding your students to handle those types of future projections as it relates to, again, debt markets going up or interest rates going up, or again, cap rates might be ultimately affected as well if interest rates start to push up a little bit?
Yeah, I love this discussion because I met with all of my coaches and we just tackled this subject. And here's the thing, I'm going to start big picture and then answer your question. The way we're underwriting deals today will be different than 3 months from today. Mm-hmm. Things are happening so quickly. And here's the other message for the listeners. If you're underwriting the same today as you were 3 months ago or 6 months ago, you're missing what's happening. You are missing what's happening because the market is so dynamic. And that could lead to, confusion, and people might say, I'm just going to sit out until the crash, but then you're missing a huge opportunity. So like right now, most of our debt is coming from bridge debt lenders, and these are variable rate loans. And so how do you account for the potential rise in interest rates? So what we're doing, number one, is we're buying interest rate caps. And by the way, I was doing bridge debt last year, and the interest rate caps were, $70,000 to buy a cap increase of, say, 1%. And now it's like triple that to buy a cap increase of 1.5%. So the rate to buy the caps have gone way up. And so you got to put that in your upfront costs. And then you also have to, on these variable rate loans, like I'm assuming that in 12 months from now, that my rate might be 100 bips higher than it is today. And so again, you either underwrite it two ways. One is, say, in years 2 and 3, you might have a higher rate, which needs to be in your cash flow model, or you just account for that up front in your equity raise and say, hey, we're going to, we know that we're going to have higher rates. And so let's model what that, like at 100 bips, what is that actual dollar amount? And let's make sure we have that in our escrow, in an owner escrow, like a working capital account, so that we're anticipating that. But you do need to anticipate higher rates. But the other thing that people want to understand is that the Fed rate that they're talking about raising is not directly correlated to the indexes that multifamily loans are tied to.
Yeah, no, understood. And I know that you had mentioned that you had just got back from an event with Tony Robbins, and at that event, it was a finance geared event, and there were 5 or 6 billionaires that were there that spoke on the current situation that we're in with Ukraine and Russia, and ultimately what the trickle down effect might be, what the impact might be here, in the U.S. Inflationary environment, what have you, and so. Maybe if you would, let's take a few minutes. Let's chat about that. If you could kind of pull back and share with us some of the valuable insights that you took away. Given the present time that we're in right now, and then tie it to that of investment real estate, what have you. But please, if you would divulge.
Yeah. So the number one problem in the economy right now, and this is my recap, by the way, is inflation. And I think most people would agree that that's probably the biggest concern that people have is inflation. And so what I want to say, just to recap, is that inflation is the biggest problem and real estate is the biggest solution, but not all real estate is the same. There's residential real estate that people live in, and there's high bubble markets, and there's markets that aren't bubbling, and then there's rental real estate. And then there's, within rental real estate, there's apartments and mobile homes, and then there's retail and all this type of stuff. And so I'm looking at my phone because I want to read some quotes, and I didn't know you were going to ask me this question, but this is from Paul Tudor Jones, one of the billionaires. And he said, if I had to pick one hard asset to own right now, real estate would be the one. Larry Summers, who was the former Secretary of the Treasury, under the Clinton administration and an economic advisor to the Obama administration, he said, buy real estate right now that does not have long-term leases. Because on a long-term lease, like if you lease a CVS and they're, for 5 or 10 years, there's going to be built-in escalation clauses and at 3%, 5%, and you can't adjust those midterm to account for inflation. But with apartments in your business, where we have 6-month and 12-month leases. And by the way, going back to what you said about underwriting, when we buy a deal, we're taking the current rents and we're moving them to market within year 1. That's called, we're marking the current rents up to market, because when these rents renew, there's literally, in some areas of the country, a 20 to 30% gap between the rent today versus these leased rents. Okay, so the type of asset you want to own is a real estate asset that you could move rents up to market. And multifamily is definitely one of the few, not maybe the only, but it's one of the few real estate asset classes that allow that. Ray Dalio said, do not be in cash. Cash is trash. And you want to own things that go up in value faster than our currency is being destroyed. Okay. And so all of those things point to, a few types of real estate, and multifamily is one of those.
Yeah, fantastic. I appreciate you sharing that. And outside of multifamily real estate, or outside of real estate in general, is there anywhere else that you're putting your own capital, Brad?
Well, we're about 70% of our net worth in real estate.
Yeah.
And that's because we're experts in it. Well, what's an expert, right? Like 10,000 hours. Well, I've been doing apartments for 20 years, so that's 40,000 hours. So I would say, whether I'm an expert or not, that I'm 40,000 hours into this.
What's the level above an expert?
I don't know. But here's the deal. And another theme that the Tony and the billionaires say is that you do want to have a few other legs, because there's always a possibility that something could go wrong in your asset class, and I get it. So like, like I'm just telling you what we do because you asked, right? There's a compelling case for Bitcoin, and I'm not a crypto expert or a Bitcoin expert, but a compelling case was made to have, say, some single digit percentage of your net worth in Bitcoin. Okay, so that's a move that we started doing a year or two ago. There's a limited amount of Bitcoin available, and I'm not here to go down that path, but that was one of the suggested moves, was take a percentage that you could afford to lose, but just buy it there and don't be a Bitcoin trader. Just buy it and don't look at it.
Yeah, set it and forget it.
Yeah, they said the short-term window is 4 years. So if you're one of these people that are going to look at your Coinbase account every day and go crazy because it's going up and down, then you don't want to be doing that. But so you buy it and you don't really look at it. And there's a few other asset classes that I was drawn to. Me and my wife Jen, we have. I don't know if it's appropriate for the show, but you'll pick up what I'm putting down. But some people call it FU money, if you know what I mean. And again, it's money that you could afford to lose, but it really comes down to betting on the jockey. And there's a few people that we know that have put together like some, higher risk venture capital opportunities. A few of those things have paid off for us really well, where some of these companies went public. There's some life settlement companies that provide stable rates of return, and that's an attractive, thing. But at the end of the day, I mean, this is my personal opinion, not Tony's. Okay, so I want to make this distinction. Mm-hmm. Once you have a certain amount of wealth that you want to protect, you could go into a more defensive strategy of maybe allocating some to different asset classes, because in the unlikely event that the one that you're bullish on doesn't perform, you have a few other legs to stand on. Yeah. But to build wealth, nobody has ever built wealth by a pure diversification strategy. This is Brad Sumrok's opinion. It's not Ray Dalio's or Tony Robbins. And what my number is, by the way, is $10 million. You need to have a net worth of $10 million to have a comfortable future, a comfortable retirement. And the way you get to that number is by focus and concentration of time, energy, thoughts, and actions. And then you could start planning on a more diversified strategy. And that's my opinion only. No, I know you didn't ask me. I know you didn't ask me that question.
That's exactly what I wanted. That's exactly perfect. Absolutely perfect. That was fantastic. I appreciate you sharing. No, I always wonder, right? Like we're all real estate guys. This is the show. I interview real estate guys only, but that doesn't mean that we're only real estate guys, right? Like typically what I find is that, 10 to, maybe 30% of our investments are diversified outside of real estate. And so I just, crypto's obviously a big thing. I'm not a crypto guy either. I've got money in Bitcoin, but it's a minimal amount as compared to my holdings in real estate. And so I'm on the same page with you there. But for me, I literally don't even remember last time I looked at my Coinbase wallet to see how much I have or where it's at. I don't even know what the price of Bitcoin's at today. I have no clue where it's at present time. But when I made that investment, it was kind of a set it and forget it. Like, let's just let it ride, right. Let it do its thing. I don't have the time or energy to mentally even deal with it on a daily basis and try to go the trader route. So I've got enough stress in my life already. In any event, well, Brad, this has been a lot of fun, man. I really appreciate you coming to the show. Glad we were able to finally connect. For those that want to learn more about you and what you got going on, your trainings, I know you've got many different events that you put out, different courses that you offer. Where's the best place to find you?
Look, it's real simple. BradSumrok.com. There's no C in my last name. It's BradSumrok.com. And there you'll see we have everything from free trainings to a $97 home study to 3-day intensive training events to mentorship programs and masterminds. Also, I probably spend way too much time on my phone, on social media. I do those myself for now. So if people send me an Instagram direct message or Facebook direct message, I tend to answer that more than I do email or a phone call.
Wow. Yeah, good for you. Yeah, that's awesome. Well, good deal, Brad. I appreciate that. And guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. You take care.